Hello, I'm Richard Winfield, the founder of Brevy Group and the creator of the Directors Academy, the independent authority on director development. I'm particularly interested in corporate governance, and today's webinar is about the extension of corporate governance to large private companies. So let's get away straight ahead with the presentation. Let's start. Okay, so here we are. Corporate Governance Masterclass. This is part of the program that I run for directors, potential and existing. The corporate governance, the Wates Corporate Governance Principles for large companies. Since the publication of the combined code by the Cadbury Committee in 1992, you reckon it's a long time ago, formal requirements to apply a corporate governance code have applied only to companies with a premium listing on the London Stock Exchange. So although those are the only people who need to apply it, then I have strongly recommended that companies of any size should take notice of it. However, things have changed. From September 2018, AIM Rule 26 has required companies listed on the alternative investment market to follow a recognized, but not specified, they have a choice, a recognized corporate governance code. So the AIM companies were brought in September 2018. From January the 1st, 2019, formal corporate governance requirements in the UK have been extended to large private companies. And that's the basis, that's the reason for my talk now. The company's Miscellaneous Reporting Regulations 2018, which are covered in another webinar, applies to all companies that satisfy either or both of the following conditions: more than 2,000 employees and a turnover of more than £200 million and a balance sheet of more than 2 billion. So they're large companies. Section 26, subsection 1 says, this is under the reporting regulations, the director's report must include a statement of corporate governance arrangements, which states, A, which corporate governance code, if any, the company applied in the financial year, how the company applied any corporate governance code reported under subparagraph A above, and if the company departed from any corporate governance code reported under subparagraph A, the respects in which it did so and its reasons for so departing. Now, these don't come into effect in practice until after January 2020, but they do cover companies with financial years starting after the 1st of January 2019. So if you are going to report on your corporate governance activities, you've actually got to have some corporate governance activities during the year. So it's quite important for these companies to recognize that they need to get something in place now, so that when the reporting comes, they've got something to say. Section 26, subsection 2, if the company has not applied any corporate governance code for the financial year, and I'm just saying it's very important that they should, the statement of corporate governance arrangements must explain the reasons for that decision and explain what arrangements for corporate governance were applied for that year. So it's absolutely essential that companies get something into practice. Very large private and public unlisted companies are required to report which corporate governance code, if any, they have applied and how. The government commissioned Sir James Wates, chairman of Wates Construction, to lead a coalition group of industry and wider society bodies to develop specific corporate governance principles as a code of practice for large private companies. And this is on the basis that the Corporate Governance Code and the long history of development of the Corporate Governance Code is specifically designed for publicly listed companies, particularly premium listed companies. And it may well be that the requirements of private companies are different, but it's still important that they do take on the basics. James Watts was knighted in the 2019 Queen's Birthday Honours. And you may be interested in a little bit about his background. He's been chairman of the privately owned building contractor for 6 years. Now, when I met him, he said that he was expecting to serve as chairman for a total of 9 years and would be prepared, if there were special circumstances, to serve for 12 years. So in terms of the general corporate governance codes, that is stretching it somewhat. So that's something for us just to be aware of, a difference. During much of that time, he's also been involved in steering industry training. He's also been involved in steering industry training and has worked to help businesses become more of a force for good in society. He chaired the Construction Industry Training Board between 2010 and 2018, helping to reform the organization. And also he's chair of Tomorrow's Company, a think tank enabling businesses to be a force for good in society, and is co-chair of Infrastructure Exports UK, which acts to promote British business internationally. So he's very involved in the industry and in good practice. And interesting, the Tomorrow's Company, this about being a force for good in society, I'll mention later about his approach to purpose. He's also a long-standing ambassador for the Prince's Trust. So he's done a lot of public service and has a wide amount of experience. The Wates Corporate Governance Principles for Large Private Companies was published by the Financial Reporting Council in December 2018. The coalition, and it's interesting to look at who's on the coalition because it is a wide range. The coalition included the British Private Equity and Venture Capital Association, the Confederation of British Industry, Climate Disclosure Standards Board, the Institute of Business Ethics, ICSA, the Governance Institute, the Institute for Family Business, the Institute of Directors, the Investment Association, and the Trades Unions Congress. The government hopes that these corporate governance principles for large private companies will be widely adopted. And in saying that, they are actually implying that they would like them to be adopted in smaller companies too. Large private companies are not a homogeneous group and are established under a variety of differing ownership and legal structures, including family businesses, private equity-owned businesses, sole owners, and subsidiaries. And that's why a different and more flexible approach to corporate governance is required. Private companies benefit from the privilege of limited liability status, but are not subject to the same level of reporting and accountability requirements as public listed companies. So they've been let off the hook up till now. However, the economic and social significance of large private companies can be as great as public listed companies. And when problems occur, there are comparable risks to as wide a range of stakeholders. So it's time that they were brought in. Companies with a significant presence in the community should be required to report on non-financial matters for the benefit of employees and of other stakeholders. A code of corporate governance for large private companies can serve to raise awareness of good practice and over time help to improve standards of corporate governance in private companies, large and small. So as I said earlier, although this is specifically for those large companies who apply under the reporting regulations, smaller or less large companies should take account because they're good practice. So there are 6 principles. The first one, purpose and leadership. Second, board composition. Third, director responsibilities. Fourth, opportunity and risk. Fifth, remuneration. And sixth, stakeholder relationships and engagement. Now, a company that follows the Wates Principles should follow an apply and explain approach in a way that is most appropriate for their particular organization. And if you get really involved in corporate governance, there are lots of arguments that about apply and explain, apply or explain, etc. But for this, it's apply and explain, and I'll show you why. Boards should apply each of these 6 principles by considering them individually within the context of the company's specific circumstances. They should then be able to explain in their own words how they have addressed these principles in the governance practices. Now, each principle is supported by guidance. This guidance is provided to assist companies in explaining their approach to applying each principle appropriate to their circumstances. Now, just to point out, this is slightly different from the Corporate Governance Code, which applies to premium listed companies. The guidance does not need to be reported on in the same way as premium listed companies need to comply or explain against the provisions in the UK Corporate Governance Code. So you are expected to apply or comply with the principles, but not with the guidance, whereas it's slightly more in more depth for the Corporate Governance Code. Companies should provide a supporting statement that gives an understanding of how their corporate governance policies and processes operate to achieve the desired outcome for each principle. So once you've defined the principle, you need to explain how you worked in order to achieve it. The importance of stakeholder engagement is demonstrated throughout the Wates Principles, and companies should outline methods of engagement with both the workforce and other stakeholders, and demonstrate how boards have considered the issues raised. And that will come up later, that it's not enough just to be engaged, you need to demonstrate what you've done about it. Subsidiary companies meeting the tests set out in the regulations are required to make a corporate governance statement. However, where practices and policies of the parent company apply to the subsidiary, it can refer to the parent company's corporate governance statement, so you don't have to go into all the detail in duplicate. So let's consider the principles. Purpose and leadership. So this is the structure. The principle here is an effective board develops and promotes the purpose of a company and ensures that its values, strategy, and culture align with that purpose. And I intimated earlier that with Sir James Wates was saying that Wates is a very well-run company, and yet they have had to work quite hard in the year leading up to this to really address what their purpose is. So this is good stuff. It stretches. His objective, the committee's objective in developing these principles, was it would stretch and focus the boards of private companies. The purpose is the first of the guidances which goes under the principle we've just had. So this purpose is this first letter of guidance is the purpose. A well-developed and defined purpose will help companies of all sizes and structures to articulate their business model and develop their strategy, operating practices, workforce, and approach to risk. Now, I'm not quoting word for word the whole of the guidance in the 6 principles, so these are my selections of the more important parts. So I do recommend, and I will give you the link at the end, that you personally get hold of your own copy and work through it, regardless of what size company you have. So next stage of guidance in this first principle, values and culture. A company's purpose and values should inform expected behaviors and practices throughout the organization. So they are there as the bedrock for decision making. A healthy culture is critical to the company's competitive advantage and vital to the creation of long-term value. Effective ways of monitoring culture include, but are not limited to, employee surveys, engagement with trades unions, absenteeism rates, exit interviews, and board feedback sessions. And this obviously can apply to any size company. Now, strategy. An effective board develops a strategy and business model to generate long-term sustainable value. The board manages conflicts of interest, and a balance should be struck between short-term targets or needs and long-term aspirations. And generally, private companies find this easier because they're not suffering quarterly reports. Next, getting on, the next principle, board composition. So the principle is effective board composition requires an effective chair and a balance of skills, backgrounds, experience, and knowledge, with individual directors having sufficient capacity to make a valuable contribution. So let's break that down a little bit first. The balance of skills, backgrounds, experience, and knowledge. This is defining something about diversity. So when you're building a board, you need to think of these things. And then the next thing about sufficient capacity, which sounds very fancy, means that it must have enough time to do the job properly. The size of a board should be guided by the scale and complexity of the company. Now, onto the guidance. The chair. Consideration should be given to separating the roles of the chair and chief executive, to ensuring a balance of power and effective decision making. So in current terms, that's fairly soft. You need just to consider, whereas in public companies, it's much more emphasized that certainly in the UK, that chair and chief executive should be 2 roles. Balance and diversity. A balanced board promotes effective decision-making and supports the delivery of a company's strategy. The board should collectively demonstrate a high level of understanding relevant to the company's business needs and stakeholder interests. So basically, this refers to the directors, that each director should have the time and energy and be involved sufficiently so they do understand what's going on and how what they do affects other people. An effective board should be able to demonstrate that there has been a considered effort to establish an appropriate balance of expertise, diversity, and objectivity. And this is becoming much more emphasized in corporate governance generally. A policy of diversity and inclusion aligned to the company's strategy can support appointments to the board and succession planning. Such a policy should also consider targets and aspirations promoted by government and industry initiatives or expert reviews. And there is another reference in this to looking outside to see what's going on. So if there are good reports or good models to follow, then take account of them. Size and structure. A board should give careful consideration to its size and structure so that it is appropriate to meet the strategic needs and challenges of the organization and enables effective decision-making. Companies should consider the value of appointing independent non-executive directors to offer constructive challenge. Again, this is a much softer suggestion than you would get in a published, in a quoted company. But nonetheless, something I personally strongly recommend. Boards may wish to delegate some functions to committees, which consider specific issues such as risk or remuneration. However, this will be dependent on structure, complexity, and size of the company. Effectiveness. The closely held nature of ownership within many large private companies means directors are often required to maintain objectivity in complex situations, in particular when there is an influential shareholder. And if I can emphasize the legal responsibility of a director, who in any company, the legal responsibility is to be responsible towards the good of the company, not to the shareholders directly. Companies should demonstrate a commitment to the ongoing professional development of their board, and directors should embrace such opportunities and ensure that they have sufficient time to discharge their duties. Regular evaluation of the board can help individual directors to contribute effectively and highlight strengths and weaknesses of the board as a whole. So no requirement on how often or how it's done, but clearly something of value. So principle 3, director responsibilities. The principle is the board and individual directors should have a clear understanding of their accountability and responsibilities. The board's policies and procedures should support effective decision-making and independent challenge. This is probably more of a challenge, shall we say, for private companies because they're more likely to have a closer team on the board. So it's something to make sure that you are running the board in such a way that not only effective decision-making, but independent challenge are open and above the board. Accountability. An effective board should establish and maintain corporate governance practice that provide clear lines of accountability and responsibility to support effective decision-making. And you'll see as you read through, support effective decision-making comes in quite frequently, because that's clearly a major role of the board. Clear corporate governance policies, practices, and company leadership, all working together, promote effective stewardship to deliver long-term value. The chair and the company secretary should periodically review the governance processes to confirm that they remain fit for purpose and consider any initiatives which could strengthen the governance of the company. Transparent corporate governance policies and practices can clarify the relationship between the company and its owners, including that of a parent company and its subsidiary, in order to deliver long-term sustainable success. And again, these words, in order to deliver long-term sustainable success, very much a theme of the practices. Committees. A board should make use of committees to help with the consideration of matters such as financial reporting, risk, succession, and remuneration. The provision of independent challenge in board and committee decision-making should mitigate the risk of individuals having unfettered powers. The independent challenge encourages construction problem-solving that benefits companies in the long term. So it emphasizes the need for independent challenge, even though it's been fairly soft on suggesting non-executive directors. So it has to be written into the culture. Integrity of information. A board should establish formal and robust internal processes to ensure systems and controls are operating effectively, and that the quality of information provided to it is reliable, enabling directors to monitor and challenge the performance of the company and make informed decisions. A board may rely on a broad range of information sources, including, but not limited to, financial reporting, key performance indicators, workforce data, environmental data, stakeholder engagement feedback, and consumer data. Board papers and supporting information should be accurate, clear, comprehensive, and up-to-date, contain a summary of the contents of any paper, and inform the director what is expected of them on each issue. This is something I strongly teach and recommend, but it's something I'm interested to see that it's actually written down. So each part of the agenda should actually explain what it's for, not just present it. Be issued in good time. Next principle, opportunity and risk. And part of Sir James's presentation was very much that companies spend a lot of time being concerned about risk, and that is absolutely right and proper. But they tend not to spend so much time on opportunity, and yet you're in business to develop opportunities. So one of the things he would like to come out of this is that people continue to focus on risk, but raise the level and the amount of time spent on looking for opportunities. So the principle is a board should promote the long-term sustainable success of the company by identifying opportunities to create and preserve value and establishing oversight for the identification and mitigation of risks. Guidance. Opportunity. A board should consider and assess how the company creates and preserves value over the long term. This requires boards to consider both tangible and intangible sources of value and the stakeholders that contribute to it. Risk. A board has responsibility for an organization's overall approach to decision-making and effective risk management, financial and non-financial, including reputational risk. So risk is clearly covered. This requires oversight of risk and how it is managed and appropriate accountability to stakeholders. Responsibilities. The board should establish an internal control framework with clearly defined roles and responsibilities for those involved. It should agree an approach to reporting, including frequency of reporting and the points at which decisions are made and escalated. Responsibilities may include developing appropriate risk management systems that identify emerging and established risks facing the company and its stakeholders, determining the nature and extent of the principal risks faced and those risks which the organization is willing to take in achieving its strategic objectives, agreeing how the principal risks should be managed or mitigated and over what time frame to reduce the likelihood of their incidence or the magnitude of their impact, establishing clear internal and external communication channels for the identification of risk factors, both internally and externally, agreeing a monitoring and review process. Next principle, remuneration. And the principle is a board should promote executive remuneration structures aligned to the long-term sustainable success of a company, taking account of pay and conditions elsewhere in the company. Now, depending on the size of these companies, some companies will come under the reporting regulations, which require the companies to report in some detail on the spread of different salaries and remunerations through the company. So it should be thought of very carefully if you need to check the reporting regulations, because if you're covered by that, then this principle has to be applied in some detail. So guidance, setting remuneration. Remuneration for directors and senior managers should be aligned with performance, behaviors, and the achievements of the company purpose, values, and strategy. Policies. The board should establish clear policies on remuneration structures and practices, which should enable effective accountability to shareholders. Policies may include robust consideration of the reputational and behavioral risks to the company that can result from inappropriate incentives and excessive rewards. So there's no discipline on how you're paid, except to be wary that if it gets into the press that it's all out of balance, that could do you some damage. Boards should consider the benefits of greater transparency of remuneration structures and policies, which will build trust from wider stakeholders. Additional transparency could extend to commenting on how executive remuneration reflects general practice within the sector or voluntary disclosure of pay ratios. Delegating remuneration decisions. The establishment of a committee is a way some boards may wish to delegate responsibility for designing remuneration policies and structures for both directors and senior management. Such a committee might benefit from the contribution of an independent non-executive director. Subsidiary companies. In some companies, director pay will be controlled by a parent company, and in such circumstances, the subsidiary should explain this and cross-refer to information available elsewhere, which explains the policy in relation to the subsidiary. So this applies several times. If you are not only a subsidiary, but a subsidiary that is significantly influenced by your holding company, then you don't need to duplicate the information. So finally, the sixth and last principle, stakeholder relationships and engagement. Directors should foster effective stakeholder relationships aligned to the company's purpose. And if I mentioned earlier, the thing that came out for Wates was that actually defining the company's purpose was a major activity. So directors should foster effective stakeholder relationships aligned to the company's purpose. The board is responsible for overseeing meaningful engagement with stakeholders, including the workforce, and having regard to their views when taking decisions. External impacts. Large private companies create their own social, economic, and environmental impact, but are also affected by changes to their operating environment. So their impact on the external environment is one of the reasons they've been brought into the corporate governance regime. But increasingly, they should take note of what's going outside and how it affects them. Sustainable business benefits wider society, and large private companies have a responsibility to create and sustain long-term value for their shareholders and stakeholders. And stakeholders does include various parts of society. Stakeholders. Dialogue with stakeholders helps boards understand the effects of policies and practices. It helps them to predict future developments and trends and to realign strategy. When explaining impact on the community or environment, boards may want to refer to recognized international standards or frameworks that it follows. So once again, it refers that you should take note of what's going outside and learn from it. Workforce. For many private companies, the largest material stakeholder group is their workforce. Companies should develop a range of formal and informal channels that enable them to engage in meaningful two-way dialogue, enabling the workforce to share ideas and concerns with senior management. Workforce policies and practice should be aligned with the company's purpose and values. Now, this is the important thing, I think, which I was looking forward. Yes, a board should demonstrate how the company has undertaken effective engagement with material stakeholders. And this is the significant bit, how such dialogue has been considered in decision-making. So it's not enough to do it. You need to demonstrate how you've taken account of it and what's the impact been. Companies may also wish to comment on any good practice which may have emerged and contributed to the success of the company. So it's an opportunity to blow their own trumpet, but also maybe to give other companies an opportunity to learn from them. So there we have it. The Wates Corporate Governance Principles for Large Private Companies is a report published by the Financial Reporting Council, and you can download it at no cost from www.frc.org.uk, and I strongly recommend that you do, regardless of what sort of company you work with. And finally, who we are. This is comes from a module in the Essential Directorship Masterclass, and you can find out more about what we're doing at the directorsacademy.com. So thank you very much.